Let's complete that first question. Super 30, first question, second question, third question. So 115 BAA we will do, 115 BAB and PGBP. Done? Continue with PGBP. NR taxation, I will upload the revision lecture for that. NR and transfer pricing, I will upload the revision lecture, okay? Okay, NR taxation, what you want to study? Any transfer pricing, some concept? No, in NR taxation there is no amendment. Chalega. But I will upload the fresh also. But in NR taxation and all, there are no such amendment. So let's start with the first question of the Super 30. Guys, if you do this question, then in your examination, whatever adjustment comes in your exam, I think 70% adjustment will be covered from here. 60 to 70% adjustment will be covered from here, from this question. So this is the master question of the PGBP. We will cover we are going to cover almost concept of the PGBP. So let's start with this question. A statement of profit and loss account of the BB Industries Limited is a closely held company. Guys, whenever you read the question, you have to read it very carefully, because BB Industry Limited is a closely held company. Closely held company means unlisted company. Just underline the word closely held company and just write unlisted companies. Just write unlisted companies. Now guys, what are the some tax provision that are applicable only for unlisted company? If you remember any provision which is applicable only for unlisted company? Deemed dividend under section 222E. Okay, if any closely held company gives the loan or advances to any shareholder and shareholder is holding the shares of 10% or more, then it will be treated as deemed dividend in hands of shareholder to the extent accumulated profit of the company. Or suppose if that loan is given to any other concern in which that shareholder is having the substantial interest, then also it will be treated as deemed dividend. Or if loan or advances is given to any relative or any person on the behalf of such shareholder or for the benefit of such shareholder, it will be treated as deemed dividend under section 222E. Any other provision? Any other provision which is applicable only for closely held company? Guys, there is one section called angel tax. Section 5627B, and section 5627B says that whenever any closely held company issue the shares on the premium and your issue price is more than the fair market value, then issue price minus fair market value, that is taxable under income from other sources. Any other provision which is applicable only for closely held company? Any other? Yeah. In set up and carry forward, there is one section 79. And what section 79 says that, you know that? Suppose any closely held company incurred loss in any year, then guys, that loss can be set off by that company only if the 51% shareholder should be same in the year in which that loss is set off. Means at the end of the year in which loss is set off and at the end of the year in which that loss was incurred. In both the year, at least 51% shareholder should be same. Then only that loss can be set off by that company. You got my point or not? Yes. So this three provision that is applicable only for the closely held company. You got my point or not? Yes or no? Yes, sir. So just we are reading the first question. Just try to understand. A statement of profit and loss account of the BB Industries Limited, a closely held company engaged in the production and marketing of the diversified product. So guys, they are engaged in the production and marketing. Production means manufacturing also. So manufacturing and marketing of the diversified product shows a net profit before tax is 72 lakh for the financial year ended 31st March 2024 after charge of the following item. Now guys, here some item are debited to P&L account, and here list is given. So total there are basically, if you count, then there are total 23 item that is debited to P&L account. Some item are credited to P&L account. So there are 8 item credited to P&L account, and after that some additional information is given. Guys, always there will be one assumption that whatever given in the additional information given in additional information, impact of that information is still not given in the P&L. That will be one assumption. Let's start with one by one point. First, we are going to start with the item debited to statement of profit and loss account. Now guys, what you have to do? First, I will give you the explanation of every point. And after listening that explanation from my side, after that just you have to just do the tick mark in the solution part. Okay, this point is completed. Okay, and just you have to read. So now we'll start one by one. First point is a depreciation as per Companies Act 2013 is 24 lakh. Guys, depreciation debited by the company of rupees 24 lakh, and this is as per the Companies Act. Is that depreciation is allowed or disallowed? Allowed or disallowed? Because depreciation as per Income Tax Act is allowed, na? So if it is debited to P&L account, you have to add back. You have to add back. So just check in the solution, is they add back or not. If it is add back, then just put tick mark. If it is add back, then just put tick mark. Okay, now second adjustment in the debit side. All people focus here. Interest amounting 60,000 for the short payment of advance tax paid as per section 234B relating to the assessment year 22-23. Guys, just tell me, in income tax, is income tax allowed or not? In income tax is allowed or not? In income tax allowed or not? Right answer is no. In income tax is not allowed. Indirect taxes are allowed, huh? But in income tax is not allowed. Sir, income tax is not allowed. Is income tax interest is allowed or not? No, it is not allowed. Income tax penalty is allowed or not? It is not allowed. So income tax is not allowed. Income tax interest is not allowed. Income tax penalty is not allowed. So here guys, this income tax interest of 60,000, it is not allowed. You have to disallow. But my question is, sir, if any income tax paid in the foreign country as per the foreign tax law, is that income tax allowed or not? There may be a question, examiner may ask you one question, a company paid 80,000 as income tax in the Switzerland as per the tax law of the Switzerland. Is that income tax is allowed or not? Huh? Sorry? No, okay, that is relief or not, that we will discuss in the international tax. My question is that will be a PGBP allowable expenditure or disallowed? Right answer is disallowed. So even income tax paid as per the Income Tax Act, Indian tax law or foreign tax law, income tax is not allowed as deduction. So income tax is not allowed as deduction, even if it is paid as per the tax law of the like India or tax law of any other foreign country. Okay, one more point. Guys, income tax is not allowed. Income tax interest is not allowed. Income tax penalty is not allowed. But income tax fees is paid. Then it is allowed or not? Like suppose TDS return you have filed late. Then there will be a 234E. There is a 200 rupees per day fees. So is that fees is allowed or not? Fees allowed or not allowed? Income tax is not allowed. Income tax interest is not allowed. Income tax penalty is not allowed. Income tax fees is allowed or not? Yes or no? Right answer is, for the fees, ICI given the two views. In the one view, ICI says that this is not a penalty and it is not a tax interest also, so it is allowed as deduction. But in the other view, ICI also write that if you treat that fees as a penalty, then it won't be allowed as deduction. So in examination, if any fees comes, you just allowed as deduction. Okay, so fees is allowed as deduction, no issue at all. Now next part, point number third. Point number third says that, try to understand guys, interest on borrowing cost amounting 9,50,000 and 7 lakh though not meeting the criteria for recognition as a component of cost included in the cost of opening and closing inventory respectively. Now guys, what happened? In the P&L account, you have included in your opening stock and closing stock, you have included 9,50,000 and 7 lakh in your opening stock and closing stock, though it is not meeting the criteria of the recognition as per the ICDS. So in the stock in trade, you can recognize the stock only if they meet certain criteria of the recognition. So if they are not meeting the criteria of recognition, then just remove that na. So when you have included in the opening stock and closing stock, but they are not meeting criteria of recognition, then you have to remove. Now guys, in the opening stock, you have included 950 and in closing stock, you have included 7 lakh. Just you have to remove the both. Now guys, in simple word, this is your profit and loss account. Now, in the profit and loss account, 9.5 lakh you have debited in the opening stock and 7.5 lakh you have credited in the closing stock. Now, if you remove the opening stock, can I say that your profit will be increased? Huh? And if you remove the closing stock, your profit will be decreased. So your profit has to be increased by 9.5 lakh and profit decreased by the 7.5 lakh or 7 lakh. 7 lakh basically it is a 7 lakh, or effectively you can do only that 2.5 lakh your profit will be increased. So add the profit of 2,50,000 for not fulfilling the criteria of recognition. So that's why it has to be added back. So 2,50,000 will be added back. So here in this particular point, just add the 2,50,000. Now point number 4. Now what point number 4 says? Point number 4 says that expenditure of 41,000 basically you paid in cash, comprising of 22,000 directly paid to the producer of any dairy farming product and 19,000 paid towards the printing and stationery of the item to a trader. Now guys, you know that whenever you make the payment in cash, then there is a one section, that section number 40A subsection 3. Now what 40A subsection 3 says? 40A subsection 3 says that in a single day to a single person, payment more than 10,000 if you made, then it has to be made by the account pay check, account pay demand draft, or any mode of electronic clearing system. And electronic clearing system covered debit card, credit card, NEFT, RTGS, IMPS, Bheem UPI and QR code. Only these payments are covered. Like more than 10,000 payments should be made by this payment mode only. Otherwise that expenditure will be disallowed. But guys, suppose for an example, if you already claimed the expenditure earlier on the accrual basis and in current year you are making payment on the cash basis, then question is that in current year, if it is payment is made more than 10,000, then current year it will be treated as your income. Huh? In current year it will be treated as your income. Now guys, limit is 10,000, but if any payment is made to the transporter, then that limit will be 35,000. If any payment is made to the transporter, then limit is going to be raised to 35,000. Now guys, in that section, there are certain exceptional cases also. There is a rule number 6DD. And rule number 6DD says that certain payment can be made in the cash. If certain payment can be made in the cash, one is the any payment is made to the government, or any payment is made to the bank, or any payment is made to the like RBI or LIC or any insurance company and all, then payment can be made in cash, no issue at all. Second is, if any payment is made to the producer of the agriculture product, fish product, meat product, poultry product, dairy product, or for the purchase of any animals and all, then cash payment is allowed. Whatever the amount, cash payment is allowed. So suppose if you made the payment to the farmer for purchase of food grain and payment is made to the farmer, cash payment is allowed, even it is more than 10,000. Or suppose if you made the payment to the fisherman for purchase of fish, then cash payment is allowed. Or suppose if you purchase any dairy product and payment is made to that producer of dairy product, cash payment is allowed. Or if you purchase any animals and payment is made in cash, that will be allowed as deduction. But that should be from the producer. Huh? Now suppose if I purchase the food grain from the big bazaar and I made the payment in cash, is it is allowed as deduction? Answer is no, it won't be allowed as deduction because big bazaar is not a producer of the agriculture product. Now one more point, guys. If there is a retirement benefit like gratuity and all, then payment can be made in cash of 50,000. There is a limit of 50,000. So 50,000 can be made in the cash. Now guys, one more point. Suppose if your employee is going on the ship or for any other place other than his normal duty place and payment is made for the salary and he is going for the 15 days or more, then payment can be made in the cash. So salary paid to your employee, he is going for any other place or on the ship for more than 15 days, then payment can be made in the cash. Or suppose if there is a book entry means suppose you are a debtor by 15 lakh or you are creditor by 10 lakh. So debtor and creditor by 15 lakh and 10 lakh you have adjusted or set off, then 10 lakh will not be treated as cash payment. Obviously adjustment entry is not treated as cash payment. Or if you are a money changer and money changer purchase the foreign currency and all, then he may make the payment in cash. And last point is, suppose payment is made at any place where banking facility is not available, then cash payment is allowed. And one more point says that if you purchase any product from any person who is manufacturing that product in the cottage industry without help of the power, without aid of the power in cottage industry, if any person is manufacturing the goods and if you purchasing that goods from that person, then cash payment is allowed. Now guys, in this particular point, what happened? You made the payment of 41,000. Out of this, 22,000 directly paid to the producer of the dairy farming and 19,000 paid towards the printing and stationery. So can I say that this 22,000 will be allowed as deduction? But guys, 19,000 is not allowed as deduction. 19,000 not allowed as deduction, but 22,000 will be allowed as deduction. Check your solution. Huh. 9,000 and 9,000 allowed? Yeah. Done, people? Now next point. 3,50,000 paid to the contractor for carrying out some repair work of factory premises. Tax was not deducted at source on this payment. Hey guys, repair work. So repairing, if there is a repair, then that is allowed as deduction. Repair is a revenue expenditure, okay? Of the factory building, I have assumed that this is the revenue repair, not a capital repair. So revenue repair is allowed as deduction. But guys, under PGBP, there are some section related to TDS and that section number is one section is a section 40 clause A subclause 1 and there is a second is a section 40 clause A subclause 1A. Now what this two sections says? First section says that if any payment is made to non-resident or foreign company, say non-resident or foreign company, and if TDS is not deducted, say not deducted, or TDS deducted but not paid to government up to the due date of return filing, then that 100% expenditure is disallowed. So if any payment is made to non-resident or foreign company and TDS is not deducted or deducted but not paid to government up to the due date of return filing, then 100% of your expenditure will be disallowed. But section 40 clause A subclause 1A says that if any payment is made to the resident person and TDS is not deducted or TDS deducted but not paid to government up to the due date of return filing, then 30% of expenditure will be disallowed. Means 70% is going to be allowed and 30% will be disallowed. Now in this particular question, guys, for the repairing purpose, you paid the 3,50,000 to the contractor for repairing work and you have not deducted the TDS. Now question is that what will be the assumption? If nothing is given, then what you will assume that expenditure is paid to the resident or non-resident. If nothing is given, you will assume that this is paid to the resident and TDS is not deducted. Can I say that 30% will be disallowed? So here guys, 30% is going to be disallowed. So 3,50,000 multiply by 30%, total comes to the 1,05,000 is going to be disallowed. Means 1,05,000 you have to do add back. So 1,05,000 will be added back. Now next point. Next point is point number 6. Point number 6 says that 35,000 is expenditure towards expenditure for earning income from transfer of carbon credit. Now guys, carbon credit point. Now what is the carbon credit? You know that there are two type of gases. One is the chlorofluorocarbon and one is the hydrochlorofluorocarbon. And due to these two gases, our ozone layer is depleting. And when ozone layer is depleting, to save the ozone layer, like UN nation and all, they came with one plan, that is carbon credit plan, and Indian government also implemented that. Now Indian government says that if any company is restricting that two type of gases, then they will get the carbon credit point. And this carbon credit points are sellable point. You can sell that carbon credit point in the market. Now question is that when carbon credit point you are selling, then where income will be taxable? Income is taxable under the head PGBP only. Because carbon credit point you got from your business only. Due to business activity you receive the carbon credit point. So carbon credit point income is going to be taxable under the head PGBP. But at what rate it is taxable? There is a one special tax rate 115 BBG. 115 BBG, and 115 BBG says that carbon credit point income is taxable at the rate 10%. At the rate 10%. But guys, this income is taxable as per on the gross basis. Gross basis means any expenditure is not allowed. Any expenditure is not allowed. Whatever your gross income from the carbon credit point, it is going to be taxable at the rate 10%. So here guys, expenditure is debited to P&L account. So when expenditure is debited to P&L account, obviously this expenditure is not allowed as deduction. It is debited to P&L account. So we will add back this expenditure. So here in this particular case, 35,000 they have given in the P&L debit side. It will be add back because this expenditure is not allowed as deduction. Just check. Just check. Just check. Done. 35,000 add back. Now next point. Next point says that contribution to electoral trust 3 lakh by way of the check. Wait a minute. 80 GGB. I know 80 GGB. I asked intermediate question that you have given the wrong answer. And now you are saying 80 GGB. Okay, very good. So contribution to the electoral trust 3 lakh by way of the check, and I will read next point also. Expenditure towards the advertisement charges in the brochure of political party registered under section 29A of the Representation of People Act, 40,000 paid by way of the check. So here guys, assessee incurred two type of expenditure. One is the contribution to electoral trust, and second is a amount incurred as an advertisement expenditure in the newspaper of political party. First question is this both expenditure will be allowed in PGBP or not? Right answer is no. Under PGBP it is not allowed because it is not a business expenditure. If any donation is made to political party or electoral trust or any advertisement given in the newspaper of political party or newspaper of the political party, then it is not a business expenditure. It will not be allowed as deduction. So under PGBP head, both is not allowed. Now question is that, is it will be treated as contribution to the political party, and can we claim the deduction under section 80 GGB, 80 GGC or not? 80 GGB is applicable for Indian companies. If Indian company give donation to any political party or electoral trust, 100% deduction is allowed, but condition is that donation should be made by any mode other than cash. And 80 GGC says that other than Indian company, if any person gives the donation to political party or electoral trust, then it is allowed as deduction under section 80 GGC. 100% deduction is allowed, but condition is that donation should be made by any mode other than cash. Now guys, under PGBP, this both expenditure is not allowed, but question is that under GGB, can we claim the deduction or not? Here assessee is an Indian company. BB Industries Limited is an Indian company. So guys, donation to the electoral trust, That is allowed because it is donation to the electoral trust or business, sorry, donation to the electoral trust or political party. 80 GGB is allowed. But question is that, sir, when advertisement made in the newspaper of political party, is it will be treated as donation or not? Because under 80 GGB, donation to the political party electoral trust is allowed. Here they made the advertisement in the newspaper of political party. So question is that, is advertisement will be treated as contribution or donation to political party or not? Now that is one question. For that purpose, we have to check the Companies Act. Now in the Companies Act 2013, here in the Companies Act 2013, guys, Companies Act 2013 define the contribution to political party. And in Companies Act 2013, in the contribution to political party, in that section, they clearly mention that advertisement to the political party newspaper, brochure, pamphlet, it will be treated as donation to political party. And guys, here deduction will be allowed under section 80 GGB. Deduction is allowed under section 80 GGB. So for electoral trust also 80 GGB is applicable, and advertisement in the newspaper of political party 80 GGB is applicable. But guys, there is a one twist here. Suppose this question was not belongs to the company, and suppose this question was of the LLP, limited liability partnership. Then this to donation, PGBP not allowed because it is not for business. Question is that, is 80 GGC is applicable or not? So electoral trust donation 80 GGC can be claimed, but political party advertisement in newspaper, is that will be treated as donation to political party? Answer is no. Because in the Companies Act it is mentioned that donation, like advertisement in the newspaper of political party, will be treated as donation to political party, but that is only for the companies. For the other person, it is not treated as donation to political party. Then guys, under section 80 GGC, this advertisement expenditure is not allowed, but under GGB, this advertisement expenditure is allowed. You got my point or not? Yes or no? So here company can claim the 80 GGB for the both the amount. But guys, if examiner asks you the question related to the any other person other than Indian company, then guys, on advertisement in the newspaper of political party, 80 GGC deduction is not allowed. You got my point or not? Yes or no? Yes or no? Done. So just check the solution. First, it is both the disallowed, and after that, under 80 GGB, both deduction are claimed. Bole, done. If you have any doubt, you can ask me. Huh? If any person have any doubt, you can ask me. Okay. Huh? Sorry? Foreign company not allowed to make any donation to political party. It's not allowed. Okay. Now guys, next point. A, please. Next point, point number 11. What point number 11 says that? Try to understand. Interest on term loan obtained from cooperative bank is 2,60,000. Interest of 1,60,000 not paid before the due date of return filing. And on 12/12/2023, it issued debenture to the cooperative bank in lieu of the outstanding interest of 1 lakh. That deducted the interest while computing the PGBP income for assessment at 24-25. Guys, we have discussed one section 43B. Say 43B. 43B was the Mukhe Nale Kone, right? So Mukhe Nore Kone. So that section saying that if any loan is taken from the bank, schedule bank or PFI or SFC or SIIC or NBFC, then you have to pay the interest up to the due date of return filing. Then only that interest will be allowed as deduction. Otherwise that interest is not allowed as deduction. Now guys, just try to understand, if your outstanding interest is converted by bank into loan, means your outstanding interest is converted into the loan under the restructuring plan of the loan. If it is converted into the loan, is it will be treated as actual payment or not? Yes or no? Yes or no? Right answer is no. That is not treated as actual payment. But guys, suppose outstanding interest was there, and just settle the outstanding interest if company issue the debenture, or company issue the bonds, or company issue any other instrument, is it will be treated as actual payment or not? Means against outstanding interest, if company issue the debenture or company issue the bonds, is it will be treated as actual payment or not? Right answer is no. That will also not treated as actual payment. So here guys, in this particular adjustment, 1,60,000 you have not paid, and for the 1 lakh interest, here company issue the debenture to the cooperative bank, it will not be allowed as actual payment. So total 2,60,000 you have to add back. Total 2,60,000 is going to be disallowed. Just check the solution. इंटरेस्ट पहले आपने खर्चा लिया था क्या? नहीं, वेव ऑफ कर दिया, कुछ भी नहीं करना. 41,1 नहीं लगेगा. हाँ, loan amount, if there is a working capital loan and waive off, then 41,1 will be applicable. It is taxable under PGBP. नेक्स्ट एडजस्टमेंट आप खुद ही देख लो, मैं नहीं बता रहा. MSME वाला है, अपन ऑलरेडी देख चुके हैं, आप खुद ही देख लो. नेक्स्ट अमाउंट आप खुद ही देख लो. नेक्स्ट अमाउंट, पॉइंट नंबर 10 आप खुद देख लो. Point number 9 and point number 10. Just read the explanation also, huh? Now guys, next part. Point number 11. Point number 11 says that actual contribution to pension scheme of the employee is 1,50,000. Now guys, there is a section 36. In 36 there is a one point, that suppose employer made any contribution for the benefit of employee under the new pension scheme or national pension scheme or central government pension scheme, or many times it is mentioned as pension scheme referred under section 80 CCD, then employer can claim the deduction. But guys, here employer can claim the deduction is whatever the employer contribution or 10% of salary, whichever is lower. Here employer contribution is 1,50,000, but question is that where salary detail is given. So guys, salary detail is given in the other information. If you check the other information, and in other information there is a point number 5, and in the point number 5 I have mentioned that eligible salary and dearness allowance for the pension scheme referred under section 80 CCD is a 10 lakh. So 80 CCD, 10 lakh rupees is your salary. So 10 lakh multiplied by 10% comes to the 1 lakh. So guys, here 1 lakh deduction allowed to the employer. 1 lakh rupees deduction is allowed to the employer. Here employer claim the 1,50,000 as deduction. So can I say that here 50,000 amount will be going to be disallowed? So you have to add the 50,000. You have to add the 50,000. Check the solution. Check the solution. 50,000 you have to add back, because you claim 1,50,000, but here only 1 lakh is allowed as deduction. Done. Now next point. Next point says that if any doubt, then you can ask me. The amount of employee benefit include sum of 4,41,000. Very interesting adjustment. Huh? The amount of employee benefit included a sum of 4,41,000 in respect of bonus payable to the employee. So this is the employee bonus. In the previous year 23-24, the company and its employee union had a dispute over the payment of bonus. So what happened in current year? There was a dispute between employee and employer related to bonus. In order to avoid the late payment of bonus, the company formed a trust and transfer the amount of bonus payable to employee to that trust. The dispute was settled in the month of the November 2024 and trust paid the bonus to the employee on the 30th December 2024. Guys, there is a section 43B and 43B says that if any bonus and commission is paid to employee, it is allowed as deduction in current year only if it is actually paid to employee up to the due date of filing of return or up to the due date of return filing. Now guys, in this particular case, what happened? There was a dispute. There was a dispute between employee not accepted the bonus. So what here company did? Company made payment to the trust and trust made payment to the employee when dispute is settled. But guys, employee got this amount only in the month of the December 2024. So this is after due date of return filing. So total 4,41,000 is going to be disallowed. Total 4,41,000 is going to be disallowed. It is disallowed because employee, it is paid to the ultimately to the employee only after the due date of return filing. So as per section 43B, it is not allowed in the current year. But now there may be one case law striking on your mind. There may be one you know that in compact there is a one case law that is related to the Shashun Chemicals Limited. Now what happened in that case law? You know that the same fact. But in that case law, what happened? Company made the payment to the trust and trust made that payment to the employee. But trust made this payment to employee before the due date of return filing. So if payment is made to employee before the due date of return filing, so in current year only that expenditure is allowed. But what happened? Assessing officer took one view. Assessing officer says that no, since you have not paid directly to the employee, so it is not allowed in the current year. So is it will be allowed in the current year or not? Answer is yes, it is allowed in the current year if it is ultimately paid to employee up to the due date of return filing. But here in this particular case, it is not paid to employee up to the due date of return filing. Here it is paid to employee on 30th December 2024. That is after the due date of return filing. So it is not allowed in the current year. Just check the solution. हाँ बोलना, आई एम लिसनिंग टू यू. Company transfer the fund to the trust before the due date. After due date, it is not allowed in current year because you have to check that on which date it is received by employee. If it is received by employee before due date, then allowed in current year. Otherwise, it is not allowed in current year. Done. Any other doubt? No. Next point number 13. Other expenses include 1,45,000 as expenditure incurred on CSR. Hey guys, if there is any expenditure on the CSR, then that expenditure is allowed or not? CSR is treated as your business expenditure or not? CSR is not your business expenditure. So any amount paid on the CSR, that is not allowed as deduction. But now question is that, sir, suppose for the CSR, if we paid to the Prime Minister Relief Fund or Prime Minister Care Fund, then obviously under PGBP it is not allowed. But can we claim the deduction under section 80G or not? Answer is yes. Because Prime Minister Relief Fund, Prime Minister Care Fund and all, it will be treated as the CSR spend. You can claim the deduction under section 80G, but under PGBP it is not allowed. But guys, you know that there are two exceptional cases. One is the Clean Ganga Fund and one is the Swachh Bharat Kosh. Clean Ganga Fund and Swachh Bharat Kosh, if that two expenditure are the CSR spent, then it is not allowed in the PGBP, as well as ATG deduction is not available. As well as ATG deduction is not available. Here clearly they mention about the only CSR. So obviously PGBP deduction is not available. So just you have to add back. After that, point number 14, that is related to the non-compete fees. Just read it. Just read it. Just read it and check the solution of this 2 point, 13 and 14. And 14. Check. Done, people? Hey, bhai, done, people? Okay, next point, point number 15. Just check it. In order to expand its overseas business, the company plan online advertisement campaign for which it engaged Fastech Science, a London-based company not having any PE in India, and paid 5 lakh for the service avail. No tax or TDS was deducted by company. Hey guys, suppose if you paid anything for the online advertisement to any non-resident person, and that non-resident person is not having any PE in India, then you have to deduct the equalization levy. If it is more than 1 lakh, then you have to deduct the equalization levy. Here equalization levy is not deducted. So can I say that 100% expenditure is disallowed? So just add back. Just add back that expenditure. That is point number 15. Now, after point number 15, point number 16. Now what point number 16 says? Try to understand. The company has made provision for gratuity based on the actuarial valuation of the 5 lakh. Actual gratuity paid amounting to only 1,20,000 during the financial year 23-24 was debited to the provision for gratuity account. Guys, there is a one section 40A subsection 7 in the PGBP. And 40A subsection 7 says that provision for gratuity is disallowed. Say provision for gratuity disallowed. Provision for gratuity disallowed. Sir, provision for gratuity is disallowed. Sir, even if it is made as per actuary valuation, then also it is disallowed. Answer is yes, then also it is disallowed. So provision for gratuity is always disallowed. Then sir, what will be allowed in the gratuity? One is the actual gratuity paid, then it is allowed. Actual gratuity paid, then it is allowed. And second is, if any payment is made towards the approved gratuity fund, that is allowed. What I am saying that approved gratuity fund, then it is allowed. So again, try to understand. One is the actual gratuity is allowed. Second is any contribution made by employer towards the approved gratuity fund, then it is allowed. And one more point, guys. Suppose if any gratuity is already due, means already that gratuity is already due, that provision is allowed. I can take an example. Suppose for an example, in my company, 2 employees left the job in the current year. When 2 employees left the job in the current year, then for that 2 employee gratuity is already due. So when gratuity is already due na, and I made the provision, that provision is allowed. So always remember that future provision for gratuity is not allowed. actual gratuity paid is allowed, approved gratuity fund contribution is allowed, or if any gratuity is already due, then that gratuity is allowed. So guys, here in this example, here you made the provision for gratuity of the 5 lakh that is not allowed as deduction. But you actually paid the gratuity 1,20,000. So 1,20,000 will be allowed as deduction. Now here we have to add back total 5 lakh and we have to reduce the 1,20,000 because 1,20,000 gratuity is paid in the current year. That is going to be allowed. Or effectively you can do the one adjustment also. Okay, since you have debited 5 lakh rupees, and you have to reduce the 1,20,000 rupees. So instead of that 5 lakh add and 120 lakh less, only you can add is 3,80,000 you can add. Just check the solution. So debited to provision of gratuity account means it is not debited to P&L. Na? It has to be debited to P&L account. It is debited to provisioning account. Means provision debited to P&L account. And this actual gratuity is debited to the provision account. Here actual gratuity of 1,20,000 should be debited to P&L account. Na? Done. Now next point is a self-explanatory. Just read it. Franchisee fees of the 20 lakh. Can I say that it is an intangible asset? And depreciation will be allowed. So just check the next point 17 and solution also. Done, people. Now next point says that, guys, many times what happens in the general business practice, if any cash is lost, means examiner will give you some type of adjustment ke when your manager, he just withdraw cash from the bank, and when he is coming to office, that time someone came and just he take away the cash from that accountant. So you lost the cash. Or sometime what happened, your cashier only did the fraud and he just take the cash at his home. So this loss will be treated as your normal business loss and it is allowed as revenue expenditure. So if there is a loss of the cash, then it will be treated as your normal business loss and it will be allowed as deduction. Just check the next adjustment. Check the next adjustment. Just check the next adjustment. Done. Now guys, next point, all people pay attention. Employer contribution to the EPF. EPF means Employee Provident Fund is 2 lakh for the month of March 2024 were remitted on the 8th June 2024. Remember here, all people pay attention. There is a one section 43B, say 43B. 43B says that if employer made the contribution towards the statutory provident fund or recognized provident fund or approved gratuity fund or approved superannuation fund or approved pension scheme and all, then it will be allowed as deduction only if the actual payment is made up to the due date of return filing. Up to the due date of return filing. And guys, in case of company, what will be the due date of return filing? What will be the due date of return filing? 31st October. So here it is made till 31st October. So it will be allowed in the current year. There is no need of any adjustment. Hey guys, but try to understand one point. This is about employer contribution. Say employer contribution. Guys, if there is any employee contribution, an employer collected that money from employee, if employer collected that money from employee towards the employee contribution to the RPF and all, then it has to be deposited up to the due date of that fund. Up to the due date of that fund. Up to the due date of that fund. And what will be the RPF due date? Next month 15. So if it is deposited till next month 15 na, then it will be allowed in the current year. Otherwise, it never be allowed. Otherwise, it will never be allowed. So if it is deposited within 15th of the next month, then it is allowed. Otherwise, it is not going to be allowed and it will be treated as the income of the employer. What I am saying that try to understand. There are two parts. First is employer contribution. So if employer contribution towards the SPF, RPF, AGF, ASF and all, then it has to be deposited up to the due date of return filing. If it is deposited up to the due date of return filing, it will be allowed in the current year. If it is deposited after due date of return filing, it will be allowed in the year in which actual payment is made as per section 43B. Now second point is a employee contribution. If anything is collected by employer from employee towards the employee contribution to RPF or ESI and all, then it has to be deposited up to due date of that fund. That fund means next month 15. If it is deposited, then it's okay. If it is not deposited till 15 of the next month, then it will be treated as the income of the employer and it is taxable under the head PGBP. It will be treated as the income of the employer and it is taxable under the head PGBP. You got my point or not? Yes or no? Done. Now next point is related to the provision. Pay attention. The company had provided an amount of 25 lakh being the sum estimated as payable to the worker based in the agreement to be entered with the worker union towards the periodical wage revision once in the 3 years. The provision is based on fair estimation on the wage and reasonable certainty of revision once in the 3 year. Oh guys, just tell me, is provision for gratuity is allowed or not? Just we have discussed provision for gratuity allowed or not? Yes or no? Provision for bad debts is allowed or not? Provision for bad debts. Provision for bad debts. Allowed or not allowed? Right answer is provision for bad debts is allowed, but only to the banks. You know, provision for bad debts is allowed only to the bank. That is 8.5% of the GTI in case of Indian Bank and 10% of aggregate average advance made by the rural branches. So it is allowed to the bank. Now question is that in income tax, other provisions are allowed or not? Other provision means like provision for warranty, provision for guarantee. Is that other provisions are allowed or not? What you feel? It is allowed or not? Other provisions are allowed or not? Always remember in examination, if provision for bad debts is given, then it is allowed only to bank. Provision for gratuity, never allowed. Other provisions are allowed or not? You have to check one line, one language. As per the ICDS number 10, ICDS 10 says that if there is any provision and if there is a reasonable certainty of that outflow, what I have used the word? Reasonable certainty. If reasonable certainty word is given, then that provision is allowed. If reasonable certainty of outflow, that word is given, it means that provision is allowed as per the ICDS number 10. So in this particular case, guys, here reasonable certainty word is given. So reasonable certainty is there, then that provision will be allowed as deduction. That provision is going to be allowed as deduction. Okay. So here provision is allowed. Just check the answer. Just check the answer. Done, people? Okay, guys, just tell me one thing. What break? Okay, guys, you know about preliminary expenses? What are the preliminary expenses means? Pre-incorporation expenses like market survey or feasibility study or share debenture issue expenditure or any like share register expenses or MOA, AOA printing expenses, drafting expenses, that is called preliminary expenses. Feasibility study and all, that is preliminary expenses. Preliminary expenses are allowed in the P&L debit side only if it is incurred at the time of commencement of new business or extension of your existing business or set up a new unit. That time preliminary expenses is incurred. That is allowed as per section 35D, but it is not allowed in the 1E installment. It is allowed in the 5 equal installment. Now guys, suppose for an example, you are having one existing business, say existing business, and you are going to start one another business. And suppose if you did any preliminary expenses like feasibility study and all, any expenses is incurred for that new business, but suppose that new business is abandoned without creating that new business, means that new business you are not going to start. So whatever expenditure you incurred for the purpose of new business, if new business is started, then obviously it will be treated as new business expenditure, and if it is a preliminary expenses, then it will be allowed in the new business. But question is that, yes, suppose if you did any feasibility study for new business and new business is not started at all, new project is not started at all. Question is that whatever expenditure incurred for the purpose of new business, is that will be allowed in your existing business as a revenue expenditure or not? That is the one question. Now guys, I can take one example. From that example you can understand very nicely. Now I am into the teaching. Earlier we used to teach face to face. After through technology we started the satellite class. After satellite also we started now pen drive class, Google Drive class, online class. Now what will be the next? After like online class, now what will be the next? Next will be, many people are saying VR. Okay, there will be a virtual reality. Miss BB said directly you can see in your front end, or one more, there may be a robotic technology. Miss robot, you can purchase the robot and BB sir robot will come to your home. He will teach you. So what happened? Suppose I have given one contract to the KPMG and I ask KPMG, okay, just give me the feasibility, just do the feasibility study and give me the report on the robotic technology. So after certain analysis, KPMG has given the feasibility study report, and in that report, they clearly mention that don't start this robotic business. Then they have given the reason also. First reason is that CA student can't afford the robot, because like CA student, we are from the very weak background. We are from the middle class family. We used to watch the lecture. Two people share the lecture. Okay. We always try to find out the free PDF book on the Telegram. We always take the Xerox of your book. So when people are not that wealthy, so don't do that business. Now guys, we have paid the 20 lakh to the KPMG, and on the suggestion of KPMG, we abandon that project. Now question is that 20 lakh is allowed in our current education business of the BB virtual or not? Right answer is yes. Means if that new business is related to your existing business, means new project was related to your existing business, then you can claim in the existing business as a revenue expenditure. Because our business is of teaching and that was related to our existing business, then it will be allowed in the current business. And there is a case law of the PVR. PVR means Priya Village Road Show. PVR talkies, PVR cinema, you know about. So PVR is having the multiplexes. In Chennai also there is a PVR. But guys, PVR, what PVR did, PVR has given one contract to one of the CA firm, consulting firm, and they asked that, okay, we will start one project, we will acquire the single screen theater, and single screen theater we will convert into the multiplexes. But that consulting firm just reject. They mentioned that don't start this business. Otherwise, it will be a loss making. So PVR has not started that business, but that feasibility study report that was related to their existing business. So it can be claimed as revenue expenditure in the existing business. But guys, one more point. Suppose if a new project that is not related at all to your existing business. I can take an example. Suppose someone told me yesterday, sir, you are looking like a South Indian actor. You should start acting. You should start the movie production and all, movie direction and all. I just inspired from him. And after that, I just asked to the KPMG, please do feasibility study or not. I can be an actor in South Indian movie or not. KPMG says that no, don't do anything. Whatever you are doing currently, just continue with that. Now that movie production related, suppose business, is that project is related to my existing business or not? No. So that expenditure will not be allowed in the current business. You got my point or not? So just check the point number 21 and 22. If it is related to existing business, it is allowed. Not related to existing business, not allowed. Sorry, related to existing business, it is allowed. Not related to existing business, not allowed. Just check it. 2 point, that is point number 21 and point number 22. Preliminary expenses. In preliminary expenses, but this is not a preliminary expense. Preliminary expenses means any expenditure when you start the new business. Here business is not started, or not a new unit is set up, or it is not an extension. So it's not covered in preliminary. It's 2 part. No, it's Indian company and other resident assessee. Yeah. In other, it is resident, then yes, it's covered. Yes, cover. Resident, it's cover. It's cover. Now guys, next point. Hey guys, you know about the IPO. IPO, what is the meaning of IPO? What is the meaning of FPO? IPO, FPO, as well as the right issue and all, is that expenditure will be allowed or not? Means is that expenditure is treated as preliminary expenses or not? So guys, IPO expenditure, FPO expenditure, right issue and all, this may be treated as preliminary if it is incurred at the time of commencement of business, or if it is at the time of the extension of business or set up a new unit, then it will be treated as preliminary. But guys, if that is not incurred at that time, then it is not treated as preliminary. But question is that, is it will be allowed in section 37 or not? Is it allowed under section 37 or not? 37 section is related to the other expenditure of the PGBP. Now guys, here I have given you the 2 type of the breakup. One is if there is an expenditure related to IPO, or expenditure related to the FPO, further public offer, or expenditure related to the right share, then it will not be allowed as deduction because it is treated as your capital expenditure. Now, if any expenditure is related to the bonus or any expenditure related to the buyback or any expenditure related to the debenture or bonds issue, then that expenditure is allowed as deduction because it is treated as your revenue expenditure. But how you bifurcate it, sir? You are saying that IPO expenditure, FPO and right, that is treated as capital. And your bonus, buyback and debenture and loan, you are saying that it is treated as revenue. How you bifurcated? I have not bifurcated. Guys, Supreme Court has bifurcated. Supreme Court mentioned in the Brookbond India case law, and in Brookbond India case law, here court mentioned that suppose if any expenditure you incurred and due to that, if any capital basis change, then it is a capital expenditure. But if capital base is not changed, then it is a revenue expenditure. So whenever you issue the IPO, your capital will increase. Whenever you issue the FPO, your capital will increase. Right share, your capital will increase. That is your capital expenditure. But for the buyback or bonus and debenture and loan, your capital will be intact. Why? Because in bonus share, there will be only capitalization of the reserve. In case of the buyback, you will create the CRR, that is capital redemption reserve. So your capital base will remain same, and loan and debenture is not covered in the capital. So here guys, on the debenture, loan, buyback and bonus, whatever expenditure incurred, that is your revenue expenditure allowed as deduction. But now there is a one case. Suppose if any company is going for IPO या FPO and that IPO or FPO is not finalized and any expenditure is incurred. For an example, you know that last year Adani Limited came for the FPO, further public offer. But guys, when they started the FPO processing and all, FPO is also subscribed also. But after that, there was a Hindenburg report, and due to that, Adani cancelled that FPO. Further public offer is cancelled by Adani. But guys, in that process, they have incurred lots of expenditure. Suppose they incurred the expenditure of the 50 lakh. In that process, they have incurred the expenditure of the 50 lakh. Question is that, is that 50 lakh expenditure will be treated as revenue or capital? Because capital has not been raised till now. Capital has not changed. Question is that expenditure will be treated as revenue or not? Right answer is no. That expenditure will also be treated as capital. Because High Court says that you have to check the intention. What was the intention of the assessee? If intention of the assessee was to raise the capital, then that expenditure is treated as capital expenditure, not allowed as deduction. Just check the point number 23. Done, people? Are done, people? Okay, now next part. There are certain income which is included in the credit side of the P&L. First point is, all people just now we will do little bit fast. First is unrealized rent of the 3,80,000 pertaining to the financial year 2021 and 21-22 recovered during the current year for the commercial property owned by the company which was already sold on the 23rd March 2023. Guys, there is a one concept called unrealized rent. Say unrealized rent. Unrealized rent is like a bad debts of the rent. Say bad debts of the rent. Guys, unrealized rent is taxable under the head house property. Suppose you were having the house property, there was an unrealized rent. Now, unrealized rent is allowed while calculating the actual rent. But guys, in the year in which it is recovered, it is going to be taxable. So unrealized rent recovery is taxable under the house property, and it will be taxable in the year in which it is recovered, even you are not a owner of that house property. Even you sold that house property, then also it is going to be taxable under the head house property only, and any expenditure against recovery is not allowed. Any expenditure against recovery is not allowed, and guys, only 30% standard deduction is allowed. So this recovery of unrealized rent is going to be taxable under the head house property, and guys, here 70% is going to be taxable in current year. Even you are not a owner of that property, then also it is going to be taxable in current year. Now next part is related to the dividend. Now dividend from the foreign company, including the expenditure 20,000, that is collection charges, incurred or earning such dividend of 1,60,000. Now guys, dividend is credited to P&L account. First point, just tell me, dividend will be taxable under which head? Other sources or business? Other sources. So it is credited to P&L account. So we will reduce from here, and we are going to be include in the income from other sources. So under income from other sources, this 1,60,000 is going to be taxable. Now next point, point number 3, we already discussed that if you purchase any machinery from outside India, and for that purpose you have taken any hedging contract, and if there is any loss or gain, then it is going to be adjusted with your block of asset. So just check this 3 point. Point number 1, point number 2, and point number 3. From answer also. Just check the 3 point. Just check this 3 point. From answer. Done, people? Done? Now next point. All people pay attention. Hey, please. Interest on bank FD of rupees 1,35,000, but this is net of TDS. Hey, just tell me, interest on FD will be taxable under which head? So here it is credited to P&L account, we will reduce it. And in other sources, it will be taxable. But gross interest will be taxable. Here it is given net of TDS is 1,35,000. So can I say that 1,35,000 is for 90%? So you have to gross up to the 1,50,000. So 1,50,000 will be taxable under income from other sources. Now next part is related to the, guys, gross revenue. This point is very interesting. Gross revenue include 5 lakh in respect of service contract for marketing of some product for N Limited for the period from 1st March 2024 till 30th April 2024. The expenses incurred on the project till 31st March 2024 is 1,27,000, which is included in other expenses and debited to P&L account. Hey guys, there is a revenue recognition. Say revenue recognition. Now guys, in case of the revenue recognition, in case of service contract and construction contract, revenue will be recognized on the POCM basis. POCM is percentage of completion method. Means whatever service contract completed or construction contract completed, only that much revenue you will recognize in current year. But guys, there are 2 exceptions in case of service contract. Try to remember. First is, if any service contract is not more than 90 days. Means if any service contract, duration of that service contract is not more than 90 days, then whole revenue can be recognized in the year in which that service contract is completed. Suppose for an example, today's date is a 17 March, 18 March. So 17 March, sorry. 17 March, today's date is a 17 March. 17 March, today I started my batch of the DT. Suppose today I started and that batch completed in the month of the April 30th. So this batch duration is of 45 days. Guys, I have I can recognize total revenue in the next year. So always remember, there is no need of POCM method here. If your service contract duration is not more than 90 days, then total revenue will be recognized in the year in which that service contract is completed. So this revenue will be recognized in the next year. So in this particular example also, guys, here there is a service contract and duration is not more than 90 days. Here duration is basically from 1st March 2024 till 30th April 2024. That duration is a 61 days. It is not more than 90 days. So total revenue and total cost you will carry forward to the next year, means revenue will be recognized in the next year. So here 5 lakh is credited to P&L account and 1,27,000 is debited to P&L account. So either reduce the 5 lakh and add back the 1,27,000, or directly you can reduce the net amount, or you can reduce the net amount, that is 5 lakh minus 1,27,000. So remaining is 3,73,000. So 3,73,000 directly you can reduce while calculating your PGBP income. Now next point. Point number 6. Industrial power tariff concession, that is 5.4 lakh received from government, was credited to the statement of profit and loss account. Guys, this is about the government grant. Say government grant. Government grant. So government grant, when government grant will be taxable? First point is government grant is always taxable under the head PGBP if it is related to business. But there is a one exception. If government grant is received for the acquisition of any asset, say acquisition of any asset, then it will not be taxable. It will be reduced from your cost of asset. If government grant is received for the acquisition of any asset, then it will be reduced from your cost of asset. It is not taxable under the head PGBP, but all other government grant are taxable under the head PGBP. But now question is that when government grant has to be taxable, your account says that, your FR says that government grant will be taxable only when all the condition attached to that grant is fulfilled. Income tax says something different. Income tax says that government grant will be taxable when it is accrued. Accrued means all condition is satisfied, or received, whichever is earlier. Whichever is earlier. So under income tax, government grant is taxable in the year in which it is received or accrued, whichever is earlier. In this particular question, guys, government grant is already credited to the statement of profit and loss account. So obviously it is already taxable. So when it is already taxable, so there is no need to do anything. Now next point, point number 7. The company made the sale. This is very interesting point. The company made the sale of 20 lakh to the A company engineers, a sole proprietary concern, in the last year on 10 October 2022. On 1st Feb 2023, 10 lakh were written off in the books as a bad debts. So in the last year only, out of 20 lakh, guys, 10 lakh already we claim as bad debts. Now due to the demise of the sole proprietor, means that person died, and the company could collect only 7 lakh towards the final settlement on 1st March 2024. The amount recovered was shown as a bad debts recovered and credited to the statement of profit and loss account. Now you have to understand this adjustment. Guys, what happened? Our company made the sale of 20 lakh. Now, this 20 lakh was sales, and suppose this 20 lakh was total bad debts. Total bad debts was 20 lakh. Now, guys, out of this 20 lakh, we claim the 10 lakh as bad debts, and this bad debts is allowed. This bad debts is allowed. But guys, remaining 10 lakh bad debts is still not allowed. Remaining 10 lakh is not allowed. We have not received that 10 lakh, but that 10 lakh bad debts is not allowed. In simple word, if I made the P&L account, then guys, in this P&L, what happened? In the credit side, we have recorded the sale of the 20 lakh. In the debit side, we have claimed the bad debts of the 10 lakh. Now guys, still this 10 lakh is included in your net profit. Can I say that on this 10 lakh, I have paid the taxes? On this 10 lakh, I have paid the taxes. Even I have not received this 10 lakh. Then also I paid the taxes. Means this 10 lakh, I paid the taxes. It is not received. Then also I paid the taxes on 10 lakh. Now guys, when company received 7 lakh from that person, then can I say that on the 10 lakh, I already paid the taxes earlier? Yes or no? So on 10 lakh, I already paid the taxes earlier. So guys, first point, this 7 lakh now not taxable. This 7 lakh now not taxable because on 10 lakh, I already paid the taxes earlier. And guys, this 3 lakh further bad debts will be allowed. Because your bad debts, remaining bad debts is a 10 lakh, but it was not allowed earlier. Now you received the 7 lakh. So 7 lakh will not be taxable because you already paid the taxes on 10 lakh. And guys, that person is already died. So you have not received anything except that 7 lakh rupees. So 3 lakh rupees further deduction of bad debts will be allowed. So in the solution, first I have reduced the 7 lakh. Why 7 lakh? Because it is included in income. It will not be treated as your income. And 3 lakh further bad debts will be allowed because in the final settlement, I have recovered only 7 lakh. Now next part. Guys, next point. Point number 8. The trade creditor of rupees 5 lakh were outstanding for more than 5 years. There is no business relationship with them. The amount was unilaterally transferred to the credit of the statement of profit and loss account. Guys, trade creditor. Trade creditor, when there will be a creditor when you made the purchase. What was your entry? Purchase account debit to creditor. Guys, there is a one section 41.1. 41.1 says that suppose if any expenditure you claim in the P&L debit side, and after some time if there is a remission of that expenditure, means there is a refund of that expenditure, or suppose that expenditure cease to exist, then it will be again treated as your income and it will be taxable under the head PGBP. So here you made the purchase, that time there was a creditor. Now you are not paying anything to the creditor. So when you are not paying anything to the creditor, then it should be taxable under the head PGBP in the P&L credit side. And since it is already credited to the P&L account, so there is no need of any further adjustment. Since it is already credited to the P&L account, so there is no need of any further adjustment. Now there are some additional information. We'll check this additional information. All people pay attention. In the additional information, point number 1. Point number 1 says that depreciation as per income tax rule is a 28 lakh, excluding the depreciation on imported printing machinery referred in point number B, that is point number B3. So guys, your depreciation as per income tax act is 28 lakh. So obviously it will be allowed. And on the imported machinery, if you remember there, that imported machinery, in imported machinery, you know that machinery you purchase for the 95 lakh. And there is a hedging contract profit is a 3 lakh. So can I say that net cost of machinery is a 92 lakh? So on that 92 lakh depreciation is still not claimed. You will claim the depreciation on 92 lakh, and that machinery is used in the printing business, and printing business is treated as your manufacturing business. So on that additional depreciation of 10% is also allowed. That additional depreciation of 10% is also allowed on this 92 lakh. You got my point or not? Arey, tell me yes or no. Now next part, point number 6. Now guys, before starting the point number 6, try to understand. Guys, in income tax, if there is any export incentive, say export incentive. Export incentive. If there is any export incentive and escalation clause, what I told? Escalation clause and export incentive, that will be taxable in the year in which reasonable certainty of its recovery is achieved. Always remember, as per ICDS, if there is an export incentive or if there is an escalation claim, that will be taxable in the year in which reasonable certainty of recovery is achieved. So if reasonable certainty of recovery is achieved, that is going to be taxable. Now what happened in the point number 6? Try to understand. In respect of the ongoing marketing contract, there was a claim of escalation in the price in the tune of the 8,50,000. So there was 8,50,000 escalation claim. Now what happened? The company had filed the lawsuit in the year 2020. Company has filed the case in the court. And in the previous year 23-24, in the current year, the court gave its judgment in the favor of company. So court gave the judgment in the favor of company. So can I say that when court gave the judgment in the favor of company, it means your reasonable certainty is achieved? When court gave the judgment in your favor, so reasonable certainty is achieved. So when reasonable certainty is achieved, then it is going to be taxable in the current year. Now what happened? The company has received only 2 lakh in the current year. Gross receipt in the profit and loss account included the 2 lakh in respect of such claim. Guys, company included only 2 lakh in their income. But in case of the escalation clause and in case of your export incentive, it is going to be taxable in the year in which reasonable certainty of its recovery is achieved. So here in this case, for total 8,50,000, your reasonable certainty of its recovery is achieved. So you have to include the remaining 6,50,000 also in your income. So remaining 6,50,000 will also be part of your income. Now next part, point number 7. The company has obtained a loan of 5 lakh from the Manu Textile Private Limited. So this company is taking the loan from another company that is also private limited. And in that company, this company is holding the 16% voting power. And the accumulated profit of that company is rupees 2 lakh. So guys, can I say that if loan is given by that other private limited company to this company, then it will be treated as deemed dividend to the extent of accumulated profit. So here accumulated profit is a 2 lakh. So 2 lakh will be treated as deemed dividend in hands of our company. Now next point, point number 8. Now what point number 8 says, that try to understand. Okay guys, you know about the retention money or not? What do you mean by retention money? Retention money means in the contract there is a one concept is called retention money. You know, in your intermediate you did the contract costing or not? So whenever contractor complete the work satisfied, work certified, out of that, you know that contractee retains some amount, and that retained amount will be paid to the assessee only after 2 year or 3 year or 1 year or whatever time limit. Now guys, our income tax law says that whatever retention money, even it is not received in current year, then also it will be included in your income. Means retention money will be part of your income. You have to include the retention money in your income. So retention money, even it is not received, but it will be treated as your income. So this is the point number 8. Read it, what this point number 8 says. The assessee executed one contract of the value of 15 lakh. Completed in the current year only. This contract is completed in current year of 15 lakh. The contractee withheld 20% of contract amount, that is 3 lakh, which would be released only after the 2 years. The amount withheld has not been credited to the statement of profit and loss account. So guys, can I say that here retention money is 3 lakh? This 3 lakh should be part of your current year income. So 3 lakh will be added while calculating your PGBP income because it is not credited to your P&L account. Now point number 9. What point number 9 says? This is very interesting point. Pay attention. Grant received from state government for acquisition of generator is 10 lakh. So we received the government grant of 10 lakh for the acquisition of generator. The generator was acquired and put to use for printing business on 1st June 2023 for 35 lakh. So guys, can I say that my generator cost is 35 lakh? But guys, government grant is 10 lakh. So can I say that I will reduce from cost of asset? Yes or no? So remaining cost is 25 lakh. Huh? Now, a sum of 5 lakh was paid as advance by way of cash to the supplier of generator. Guys, if any amount is paid in cash more than 10,000 in a single day to a single person, it will not be included in your actual cost. Because that is given in section 43.1 also, and 43.1 is related to your explanation of actual cost, and 43.1 says that in a single day to a single person, if cash payment is made more than 10,000 for acquisition of any asset, it will not be part of your actual cost. So guys, this 5 lakh will also be not part of your actual cost. So here your actual cost of generator is at 20 lakh for the purpose of depreciation. Now next part. This is an interesting point. Further, following expenses related to the acquisition of asset is transportation charges paid to the transporter 25,000 in the cash. Guys, when we are purchasing the generator, so generator, like we are transporting through the transporter, and we paid the 25,000 in cash to the transporter. It is allowed or not allowed? Allowed or not allowed? Means it will be part of your actual cost or not? Yes or no? Yes or no? Right answer is transporter, you know that for transporter, that limit is 35,000. But that 35,000 limit is for revenue expenditure. That is given in section 40A subsection 3. In the 43(1), there is no limit of 35,000. In 43(1), there is a limit of 10,000 for everyone. Means if you acquired any asset and any expenditure related to asset, then here limit is 10,000. This 35,000 limit is not applicable. So here guys, it is made in the cash. So it will not be part of your actual cost. It is not part of your actual cost. It is not allowed. You cannot claim the depreciation of this 25,000. Next is installation charges paid to Mr. Ali is 35,000 through the Bhim UPI. Yes, it will be treated as your actual cost. And guys, your total generator cost will be 20 lakh and 35,000. And on this 20 lakh 35,000, you can claim the depreciation as well as the additional depreciation because it is used in your manufacturing business. Since it is used in your manufacturing business means printing business. So printing business will be treated as manufacturing business. So on 20 lakh 35,000, you can claim the normal depreciation as well as additional depreciation. Now next point number 10. What point number 10 says? Point number 10 says that during the year, company issued the 1 lakh equity shares at 10 each, was issued at 25 per share, and fair market value as per rule number 11 UA is 17 per share. This is about the angel tax. Whenever any closely held company issue the share, and if share is issued on the premium, then guys, your issue price minus fair market value, that difference is going to be taxable under income from other sources. So here guys, share is issued at 25, fair market value is 17, difference is 8, and multiply by there share is a 1 lakh. So this 8 lakh is going to be taxable under income from other sources. So in hands of company, that 8 lakh is going to be taxable under income from other sources. Now next point number 11. Try to understand what point number 11 says. Point number 11 says that the asset was purchased for 6 lakh. This point they never asked in the CA final till now. Huh? This point number 11. They never asked till now in the CA final, but I feel they may ask in the CA final. This point I picked from the CA intermediate. Now what this point says, try to understand. Huh? But this is very interesting point. The asset was purchased for 6 lakh on 17 November 2022, last year, for conducting the scientific research, and the deduction was already claimed under section 35 in the Income Tax Act 1961 in the last year. In the current year, the asset was sold for consideration of 8 lakh. Hey guys, you know that whenever you purchase any asset for scientific research, now this asset cost was 6 lakh na. So 6 lakh already allowed under the head PGBP under section 35(1)(4). Means whenever you purchase any asset for the scientific research, then guys, deduction is allowed under the head PGBP. So in last year, this deduction is already claimed. In the previous year 22-23, deduction 100% already allowed. Now what will happen at the time of sale of asset? Guys, if you selling that asset directly from laboratory, then law says that here under the head PGBP, something is going to be taxable. How much amount will be taxable under the head PGBP? You know that whatever selling price or deduction under section 35, whichever is lower, that lower is taxable under the head PGBP under section 41 subsection 3. And guys, if your selling price is more than cost, then it will be taxable under the head capital gain also. So guys, under this section, you sold that scientific research asset for the 8 lakh rupees. So 8 lakh is selling price. Deduction you have claim is a 6 lakh. So first add this 6 lakh under the head PGBP. So 6 lakh will be taxable under the head PGBP. And since your selling price is more than cost, and this 2 lakh is going to be taxable as a short-term capital gain, because capital asset is acquired last year only, and in current year you are selling that asset. So 2 lakh is treated as your short-term capital gain. So always remember, if any asset is acquired for the scientific research, you claim the 100% deduction. And suppose after some time, if you are selling that asset, then your selling price or deduction claim earlier under section 35, whichever is lower taxable under the head PGBP under section 41(3). And guys, if your selling price is more than cost, then selling price minus cost, it will be treated as your capital gain. Last adjustment of this question. This adjustment says that employee contribution to EPF is 2 lakh. Recovered from their salary for the month of March 2024, shown in the balance sheet under the head sundry creditor, was remitted on the 31st May 2024. Guys, if you know that, I have mentioned that if you received any amount from employee as an employee contribution towards the PF or ESI and all, it has to be remitted in that fund up to the due date of that fund, up to the due date of that fund. If it is not remitted up to the due date of that fund, then it will be treated as income of the assessee. Now due date of that fund is the next month 15. Here guys, this amount is recovered for the month of the March. So can I say that it has to be deposited till 15th of April? Till 15th of April. If it is not deposited till 15th of April, then guys, it will be treated as income of the assessee. So here it is deposited on 31st May 2024. That is after the due date of PF. So it will be treated as the income of the assessee. You have to add while calculating your PGBP income. You have to add while calculating your PGBP income. So this is the first question.